Imagine you have $10,000. Not a dream, real money, sitting in your account. And inflation? It's eating it alive, right now. One of them will lose money, the other won't. The question is, which one? Finance Mind. Max versus Jake. Two choices, two futures. March. Both of them just got $10,000. Maybe a bonus, maybe an inheritance, maybe poker winnings, doesn't matter. What matters, they have money.
Wow.
And they need to put it somewhere. Max sits at a desk, opens 3 browser tabs, a notebook, and a calculator. Okay, $10,000. Inflation is running around 3.5%. If I just hold cash, I lose at least $350 in real value by year end. Option 1, bank deposit. Option 2, bonds. Time to run the numbers. Jake is lying on the couch. Bro, no question, deposit. My bank's offering 4.5%. That's clean. Open the app, hit the button, done. Profit. Now I'm watching Netflix. One spent 30 seconds, the other will spend 30 minutes. Guess who comes out ahead? While Jake is watching Netflix, Max is reading. And here's what he finds. A bank deposit is simple. You give the bank money, the bank pays you interest. Current rate, let's say 4.5% annually. $10,000 times 4.5% equals $450 in 1 year. Sounds decent, right? Wait, what about taxes? What about real inflation? What if rates drop in 6 months and the bank resets the terms? Meanwhile, Jake is on episode 2 of season 2. Bro, I just dropped $10,000 into a deposit. 4.5%. I'm an investor now, man. Serious guy. Did you look at bonds? Bonds? Isn't that for old people? Nah, man. Deposit is simple and clear. Why complicate things? Here's what Max found in that hour. A bond is when you become the bank. You lend money to a government or a company. They pay you a coupon, a fixed rate, every 6 months or a year. At the end of the term, you get the full principal back. Look, 10-year U.S. Treasuries are currently yielding around 4.3%. That's below the deposit rate. But the rate is locked in for 10 years. The deposit? 1 year, maybe 2. Then the bank says, sorry, 2% now, and that's that. 6 months later, Jake opens the banking app. Oh yeah, $225 in interest, already, in 6 months. Jake screenshots it, sends it to the WhatsApp group. Jake to Max. So did you finish calculating? How much did you make on your bonds? I haven't bought any yet. What? It's been 6 months. I'm studying the market. There are nuances with duration, credit ratings, coupon tax treatment. Bro, you missed 6 months of income. You realize that? Okay, let's be honest. At this point, Jake is right. While Max was analyzing, Jake was earning. This is called paralysis by analysis, and it's a real problem, not a made-up one. But the story isn't over yet. Month 9. The Federal Reserve signals rate cuts in the coming quarter. Max watching the news. There it is. This is where the real conversation begins. Because deposits and bonds aren't just different rates. They're fundamentally different instruments with completely different logic. And if you don't understand that, sooner or later, you'll get a surprise. Difference 1. Term and flexibility. A bank deposit, usually 3, 6, or 12 months. Maximum 2 years. Bonds. Anywhere from 1 year to 30 years. Want to lock in today's high rates for a decade? Only bonds can do that. Wait, bank updated my terms. Renewal rate is now 3.1%. It was 4.5%. Now it's 3.1%? How is that even legal? I thought 4.5% was permanent. No, Jake, it's not permanent. That's the main trap of the deposit. You see a high rate, you take it, you're happy. Then renewal time comes, and the bank gives you a new rate, the one that benefits the bank. Difference 2. Who owes whom? Money in a deposit, that's the bank's debt to you. If the bank fails, there's insurance. $250,000 per person in the US, 100,000 euros in Europe. Above that limit, you can lose it. A bond is a direct debt obligation. U.S. Treasuries, that's the U.S. government's debt. Default chance, lower than falling off a couch. So, deposit, bank risk, plus annual renewal uncertainty. Bonds, issuer risk, but the rate is locked. Difference 3, liquidity and market price. This is the least obvious, and the most important. When you buy a bond, you're not just buying the coupon. You're buying an instrument with a market price. And that price moves inversely to interest rates. Rates go up, bond price falls. Rates fall, bond price rises. Which means this: when the Fed starts cutting rates, the bonds I buy now will increase in price. I won't just earn coupon income. I'll get capital appreciation on top. Wait, what? Hold on. Does this mean Max knew about this? December, 1 year later. Time to tally the score. Jake's deposit matured. $10,000 plus $450 interest equals $10,450. Inflation for the year, 3.5%. Real purchasing power gained, roughly $100 in real terms. Well, $450 is $450. Better than nothing. How much did Max make? In month 9, Max bought 10-year treasuries at a yield of 4.3%. He paid slightly below par. Rates were near their peak at that point. Coupon income for 3 months, roughly $107. Then the Fed announced rate cuts. Bond market prices rose. Max didn't sell, but if he sold right now, price appreciation on the principal, roughly $340. Total in 3 months, $107 plus $340 equals $447. Almost what Jake made in an entire year. 3 months. Yep, and I still have 9.5 years of coupons ahead, at 4.3%, regardless of whatever the bank decides to do with deposit rates. Okay, explain it to me again, from the very beginning, but without the duration stuff. With pleasure. And here's where it gets really interesting. Because the right answer isn't deposits are bad, and it's not bonds are always better. The right answer depends on 3 things. Question 1. How long can you keep this money invested? Less than a year? Deposit wins on simplicity and ease. More than 3 years? Bonds start to make real sense. Question 2. Where are interest rates headed? Rates rising, short deposits stay flexible. Rates falling, long bonds give you a double win. Coupon plus price appreciation. Question 3. Do you need access to your cash? Early deposit exit, usually a penalty. Bonds can be sold anytime on the secondary market. Wait, so bonds, they're actually liquid? Treasuries are among the most liquid instruments on the planet. I thought they were like a deposit, but worse. That's a very common misconception. I'm an idiot. No, you just didn't know. Those are completely different things. Okay, let's be straight. Jake isn't dumb. He made a reasonable choice with the information he had. The deposit works. He didn't lose money. He even made some. But here's what Jake missed. Inflation isn't an enemy you beat once. It's a long-term war. And in a long-term war, the tool matters. Bank deposit. Pros. Simple, familiar, insured, flexible in the short term. Cons. Rate resets every year. No price appreciation. Bank controls the terms. Bonds. Pros. Fixed rate for years. Price appreciation when rates fall. Highly liquid. Direct obligation. Cons. Requires some market knowledge. Price can temporarily dip. Slightly more complex to set up. Alright, I'll take the loss. It's not a loss. You've got $450. I've got a position and a strategy. Neither of us wasted the year. Next time? Bonds? Next time. Depends on the situation. But this time, with actual understanding. That's the whole secret. Not deposits are bad. Not bonds are for smart people. Just this. Understand the instrument you're using. Because inflation doesn't ask whether you understood or not. It just works. Every single day. If you made it this far, congratulations. You already know more than 80% of people who just let their cash sit and shrink. And if you opened a deposit without thinking about bonds, don't sweat it. I literally just figured this out too. I wish you financial decisions made with real understanding, not on autopilot. And I wish your money grows faster than inflation, always. Even when you're watching Netflix. Subscribe, hit like, and drop a comment. Are you team deposit or team bonds? Finance Mind. 2 choices, 2 futures.